Thanks for joining us, everyone. This is Sage, and welcome to the Executive Corner by Kalkine TV. And this is an executive talk, and in today's talk, we are very lucky to have with us Mr. Chris Gosselin, the CEO of Australian Fund Monitors. So we bring you the industry leaders, successful business owners, market and equity advocates, all under the one roof to help you discover the insights of the stock markets and help you understand how you can create multiple passive income streams. So, like I said, in today's live show, we have Mr. Chris Gosselin, the CEO of Australian Fund Monitors. Welcome, Chris.
Thank you very much. Nice to speak with you.
Yes, it's a pleasure to meet you. So to give the viewers some background, Australian Fund Monitors provides the most comprehensive source of information on absolute return, hedge funds and alternative investments in Australia. So I'm sure they're keen to hear from you directly, Chris. So let's begin the discussion. Fund research is a complex area, particularly as Australian Fund Monitors covers not only the traditional long-only funds, but also, as we just mentioned, the absolute return and hedge funds, as well as the alternative investments in Australia. Can you tell us a little more about how you provide information useful to both investors, advisors and fund managers, please?
Well, it's an online service through fundmonitors.com. Everything seems to be online nowadays, but the benefit of that is the information is always up to date and it's comprehensive. So as you said, we have over 600 funds on the database, and for each fund, we have a profile. That profile covers all the information an investor or their advisors or necessarily a fund manager needs to know about a particular fund. So a fund manager might use it for competitive information and to see where they sit in the rankings. An investor and an advisor use it to make sure they understand what it is about the fund that is either good or bad and what they need to look at. So it's absolutely essential, if you are looking at investing in a managed fund, that you understand everything about it, but also the risks. Most fund managers tend to talk about how well they've done and what their performance has been. But what's really important really is what's the risk? Every investor has a slightly different risk tolerance. So the profile will show you that. It will allow you to compare funds in an easy to view way.
That's fantastic. Sounds like the ideal one-stop shop for investors and advisors. So Australian Fund Monitors offers an easy-to-use database which compares over 600 funds' performance, risk, terms and fees. And why do you think that monitoring these funds and their performances, apart from what you've already touched on, the risk factor, why else is it essential?
Well, the reason it's essential is that it's completely independent. There's no advertising to it. Every fund can be included. There's no cost for a fund to be included. So you don't get a biased or a limited view of what's available. But it is absolutely essential because, as we said, a fund manager will always tell you the good things about their fund, but you need an independent view and an ability to compare funds, not only against each other, but also against their underlying market. So is their performance really good, or is it just average? So compared with their peers, how good is it? And being able to sort, or let's say slice and dice the database and sort and select funds based on strategy or geography, how long they've been operating for, that's really important. And if you're not really able to analyse all the funds in the universe, then it's a bit like pinning a tail on a donkey. You know, you're just taking pot luck based on what the fund manager says. Now, we're certainly not suggesting that the fund managers don't tell the truth by any means, but obviously any fund manager wants to portray their fund in the most positive light. It's only by getting independent information and independent comparisons that you can really see what suits the individual investor.
Absolutely. I think being able to compare the funds with their peers is absolutely essential, without a doubt, and it will remove any veneers from the glossy advertising that we sometimes can be persuaded by. So with so many funds on offer, you've said maybe over 600, how does an investor choose the best one, and is there such a thing as the best fund?
Look, there probably isn't such a thing as the best fund because every investor's requirements are different. So you'll often see funds say, oh, we're recommended or we're highly rated or whatever it may be. But the needs and requirements of a retiree may be completely different to the needs and requirements of someone who's still in the workforce or half their age. So what works for one investor doesn't necessarily work for another investor. So that's really important. That's why we always say, look, there isn't a best fund. You've got to find the best fund for your purposes. And the second thing is, we actually are a great believer in diversification. So all funds have their good and bad phases. Some go through good stages, some go through bad stages, some perform well in certain market environments and less well in other market environments. So our advice to investors, apart from compare funds, is don't invest in a single fund. So that concept of one single best fund. If you spread your investments across a number of funds and create a portfolio, you're increasing your diversification. Now, whether you do that across 4 funds or 5 funds or 10 funds will depend on how much capital you have to invest. But that diversification is really important. And not only diversifying amongst fund managers, but diversifying across strategies so that you might have a certain amount in equities, as you would in a normal portfolio, and a certain amount in property, fixed income, etc. Then you should diversify and create a portfolio. And the fundmonitors.com database allows you to create a portfolio and see the underlying performance of the portfolio itself, but also the components that go to make that portfolio.
That's a fantastic feature to be able to tell our viewers about. Hopefully some of them will reach out to you to find out more about that. Sure. Can you now touch on the more advanced analytics and portfolio tools offered by the Australian Fund Monitors to aid advisors in providing the clients with the best possible outcome, please?
Yeah, there are a number of tools there. So for each fund, as I said, we provide a profile, and that's a pretty extensive profile with description, what research is available, what availability, which platforms they may or may not be on, their risk factors. There's also a section called Advanced Analytics, and Advanced Analytics provide exactly what the name suggests, which is absolute details of the fund compared with its underlying market, whether it's the ASX or whether it's global equities or whether it's fixed income. It allows them to look at the detailed performance over 1, 2, 3, 4, 5 years and since inception, looking at it in a whole range of different ways, whether it's up capture, down capture, drawdown, best performance, worst performance. It does really focus on risk as well as performance. So it's comparative performance, not only of the fund versus the underlying market, but the risks involved in doing that. Now, we believe that risk is absolutely vital. When you're looking at a fund, it shouldn't only be, I want the best performing fund. It's, I want the best performing fund with the lowest possible risk to suit my risk tolerance.
Fantastic. Being such a competitive sector, I think that'll really help the advisors to stay at the top of their game.
Retail, and there are other things as well. Advisors can choose to send the portfolio to a client, so they can create a portfolio for a client and send it to the client, so it allows the client to see it as well. So there are advisor services in there that go with the access to the Fund Monitors database.
Incredible! It sounds like such a transparent, open source facility. So retail research on managed funds has been described as a dark art, and possibly because the fund managers themselves commission and pay for research to be conducted on their funds, leading to some potential conflicts of interest. What is your take on the same? And how does Australian fund monitors provide clear, truly independent, comparative information for self-directed investors and their advisors, please?
Look, it's a really good point, and it is a bit of a dark art. There's always concern in any industry, whether it's financial services or any other industry, where the person selling the product is actually paying for the research report or the rating. Now, I'm not suggesting that there's any sort of untoward activity in the background there, but inevitably there is a conflict of interest, and fund managers can pay $25,000, $30,000 a year to get a rating from the big ratings houses, and they have to have that to enable their distribution. Now that causes a problem for fund managers who either don't want to pay for the rating, or there's that inherent conflict. How we overcome that is by saying every fund in the database is there at no cost. So there's no cost to be involved on the fundmonitors.com database. Certainly the manager can pay to raise their profile or for added services such as videos and those sorts of things. But essentially the information on every fund is the same, and it's very factual and analytical. It's independent. So we're not giving an opinion to say this fund is better than that fund. As I said before, that's up to the investor or the advisor to use the database and to use the information to make their selection and keep up to date with that. The information's updated every month. So research is as we say, it's a dark art. There are all sorts of issues with it. If you want a necessary evil, I'll get into trouble with other research houses for saying that, but that's the reality of it. There's an excessive qualitative aspect about the research, whereas we look at quantitative information, and that's really important. There's an old saying in the industry that says words are words and promises are promises, but only performance is reality. And I think that's actually very true. You can have all sorts of words dressed up, whoever it is by, and all sorts of promises, but at the end of the day, it's performance that's really important, and that's what we focus on.
Absolutely, Chris, and we hear too many of the stories about the vulnerable people being told these empty promises and it ending up in quite devastating consequences in some cases. So Australia is reported as having a fourth largest pension fund market in the world. Why is it so, in your opinion, and how lucrative is it to invest in them?
Well, it is. I mean, we go back to the start of superannuation and the superannuation system that Paul Keating introduced way back in the last century. And that has grown to be significant, that compulsory superannuation. Whilst there's a lot of money in superannuation, there's also a lot of money outside superannuation as well. So it doesn't matter whether it's a large superannuation fund. There are an awful lot of people, probably a lot of your viewers, have self-managed superannuation funds. I think there are something like 660,000 self-managed superannuation funds registered with the Australian Taxation Office. And there's a huge pool of money there. So if investors are looking to superannuation to fund their retirement, a lot of those investors are saying, we'd like to do it ourselves. And if you're doing it yourself, you're a self-directed investor, and you need the information to be able to make sound, informed decisions. It's absolutely essential, and superannuation will continue to grow. We're the envy of the world when it comes to superannuation. It sometimes becomes a bit of a political football as to whether the superannuation guarantee levy should go up as fast as the government's wanting it to, or as slowly as the government of the day is wanting to. But it will increase, and the benefit of superannuation and the system we have is that it starts from your first day in the workforce. You are starting to save for your retirement. Now, it's compulsory saving. You can put more in. But that means that over a 40-year work lifespan, by the end of that time, you should have accumulated enough money, as long as it's sensibly invested, to fund your retirement. And that's the whole policy of it. It is the fourth largest pool of retirement funds in the world. And yes, it is very lucrative. If you've got such a large amount of money, it is lucrative. It's not only important for the investor, it's important for the investor to see what the fees are when they're investing in these funds. Now, we don't monitor superannuation funds, we monitor managed funds, but they're funds that those self-directed investors invest in. So being able to see what the fees and the terms are and what the risks are really important to make sure that retirement savings are looked after.
Absolutely. And it's interesting to see the federal government's budget focus on women's superannuation and women getting back into the workforce with casual work and less hours than the male counterparts as well. We actually are reaching the end of our discussion now. I wish we had more time to talk about these fund monitoring facilities that you provide. But ETFs have grown in popularity over the last 12 months, or passive funds, and they've shown, as well as huge growth, that they are actively managed funds and hedge funds over time. They can crowd out these, given the market has been in an upward trend for so long. What do you think is the case there?
Look, I think there's a place for ETFs in the market, especially if you want that passive investment. If you want to say, I want to get the return of the ASX 200 or the S&P 500 or whatever the underlying index is, then a passive fund, an ETF, and you're now getting more active ETFs as well, is a great way to do it. The risk of ETFs is they follow the market. Just by definition, they follow the market. And whilst the market's been going up, as it has been continually, really, apart from a short blip last year when COVID hit, it's been going up for a long time. That's all well and good. You know, the rising tide lifts all ships. The danger is that when there's a downturn in the market, those funds will fall with the market. And we have to remember that equity markets are very volatile. If you look at an equity market versus many other markets, they are much more volatile and they're open to quite sudden and sharp swings. And that's the risk of an ETF, and why we would suggest people, by all means, put an ETF in as part of their portfolio to get exposure to a specific market, ASX 200, for instance. But then add additional funds around that. We talked about diversification before. So look at some funds to diversify that risk. And there are certain funds that are much more defensive than others. So if you blend an ETF with a range of actively managed funds, then you're going to get the best of both worlds. You will tend to miss out on some of the upside possibly, but that's not the important thing. Is if you're investing in a managed fund, you're doing it over a period of time. It's completely different to share trading. Share trading, you can buy and sell on a daily basis. But if you're investing in a managed fund, whether it's one that's investing in equities, and now cryptocurrency funds are coming into play, or whether it's property or fixed income, then you're investing for the long term and you're outsourcing the management of your investment. So look at it over the long term. Don't look at it as a short-term effort, and diversify.
Absolutely. Thank you so much for your time, Chris, and your valuable insights. I'm sure our viewers' interests have been piqued after that fabulous show. Was there any final comments you'd like to add to the viewers before we wind up today?
By all means, go to the website. There's free access at the current time, so you can go to www.fundmonitors.com and try it for yourself. Register, As I say, there's no cost, and there's over 600 funds there that you can look at.
Absolutely. Thank you again, Chris. There was some very encouraging information. And
nice
that
to
was
speak
Chris
to you,
Gosselin.
Sage.
You too. The CEO of the Australian Fund Monitors. And if you missed some of Chris's insights, you can view the full interview via 𝐊𝐼𝐴 Media's YouTube channel, hopefully by tomorrow. And thanks for joining us. Enjoy the rest of your day. And as we say, stay apprised and invest wise with 𝐊𝐼𝐴.